One decision about your home could cost your children $75,000 in taxes they never expected to pay. Most families assume leaving their house to their kids is straightforward, but the IRS sees it very differently depending on whether you gift it now or pass it through inheritance. If you own a home and want to protect your family's future wealth, this video was made exactly for you. Stay with me because what you learn in the next few minutes could save your kids a fortune. So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you're actually buying, and more importantly, why you're buying it. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. Let me start with a real story that happens every single day across America. Two families lived in the same suburban neighborhood in California. Both bought their homes in 1998 for around $220,000. Fast forward to 2024, and both properties are now valued at $850,000 due to decades of steady appreciation in the housing market. The first family did everything by the book. When the parents passed away, the daughter inherited the home and later sold it. Because of the stepped-up basis rules under the Internal Revenue Code, her taxable gain was almost nothing, and she paid less than $2,000 in capital gains taxes. The second family tried to be proactive. The father added his son to the deed while he was still alive, thinking this would avoid probate and make things easier after he was gone. When the son eventually sold the house, the IRS treated it as a gift with carryover basis. The son received the original $220,000 cost basis and ended up owing $94,000 in combined federal and state capital gains taxes on the full appreciation. Same house, same neighborhood, same current value, but a massive difference caused by one uninformed decision. This is not rare. Across the country, thousands of families lose tens or even hundreds of thousands of dollars every year because they do not understand how cost basis actually works in estate transfers. Right now in today's market where home values have skyrocketed since the early 2000s, this issue has become more expensive than ever. People who bought homes decades ago are sitting on huge unrealized gains, and the tax code creates very different outcomes depending on timing. The core concept is cost basis, which is simply the value the IRS uses to calculate profit when a property is sold. When you buy a home, your cost basis is the purchase price plus certain improvements. When you sell, you subtract that basis from the sale price to determine your taxable gain. The IRS treats lifetime gifts and inheritances completely differently, and this distinction drives everything else. A lifetime gift carries over your original low-cost basis to the recipient. This is called carryover basis, and it means your children get taxed on all the appreciation that happened during your lifetime. An inheritance, on the other hand, qualifies for a stepped-up basis under Section 1014 of the tax code. The basis resets to the fair market value on the date of your death. So if the home is worth $850,000 when you pass away, that becomes the new basis. Your kids can sell it soon after and owe taxes on almost nothing. This single rule is one of the biggest tax advantages available to regular families, yet it gets surrendered constantly through well-meaning but misguided planning. Adding children to the deed is one of the most common mistakes. It feels like a simple way to avoid probate, but it immediately transfers partial ownership. That triggers potential gift tax reporting if the value exceeds the annual exclusion of $19,000 per person. More importantly, the gifted portion keeps your old carryover basis, so part of the future sale will be taxed heavily. On top of the tax hit, you also create serious creditor risk. If your child faces a lawsuit, divorce, or bankruptcy, their ownership stake can be seized by creditors or divided in court. You thought you were protecting the family home, but you actually exposed it. Irrevocable trusts present another trap many estate planners fail to highlight clearly. Families set these up to protect assets from nursing home costs or future creditors. But if the trust removes the home from your taxable estate, the stepped-up basis is usually lost. The children inherit the low carryover basis and face the full capital gains tax later. This is especially painful in high-value areas where homes have appreciated 4 or 5 times since purchase. In community property states like California, Texas, and Arizona, there is an extra advantage. When one spouse passes, the surviving spouse can receive a full step-up on the entire home, not just the deceased half. This double step-up can be worth tens of thousands in tax savings, but only if the title is held correctly as community property. Most people never hear about the Medicaid 5-year look-back rule until it is too late. If you gift the home to qualify for government assistance and then need care within 5 years, Medicaid can penalize you by delaying benefits. You lose both the tax advantage and the protection you were seeking. Avoiding probate by gifting early often costs 5 times more in taxes than probate fees would have been. Probate in most states runs 2 to 4% of the estate, while capital gains taxes on appreciated property can easily reach 15 to 20% or more when state taxes are added. The Revocable Living Trust stands out as the clean solution for most families. You keep full control during your lifetime. The home stays in your estate for tax purposes, so the stepped-up basis is preserved and probate is avoided. This structure gives you the best of both worlds. The numbers are clear, and the research from IRS publications, Fidelity Smart Asset, and specialized estate law firms all confirm the same reality. Families who understand these rules protect far more wealth across generations. What most people do not realize yet is that the decisions being made right now in kitchens and law offices across the country will determine whether the next generation receives a clean asset or a tax burden. The housing market has created enormous embedded gains for baby boomers and older generations. How those gains are transferred will either build family wealth or destroy it at the moment of transfer. The curiosity here is that the fix is not complicated once you see the pattern, but you have to see it before you act. The next part of this video goes much deeper into the exact mechanics and the little-known traps that catch even careful families, so you can avoid becoming another statistic. If this is making sense so far, go ahead and hit that like button. It genuinely helps this channel reach more people just like you. And this is where most people stop reading, stop watching, stop paying attention. But the ones who stay are about to understand something that could completely change how they see their money and how they plan for the people they love most. The shocking truth is that the IRS does not care about your good intentions. They only look at the legal structure of the transfer. Once the deed is signed or the trust is funded, the tax consequences are locked in with almost no way to undo them later. A little-known statistic from estate planning research shows that over 60% of families who transfer real estate during life unintentionally eliminate the stepped-up basis and create unnecessary 6-figure tax events for their children. This pattern interrupt should stop you cold, because it means thousands of parents are accidentally choosing the more expensive path while believing they are being smart. Let us go through concrete numbers so the stakes become real. Take a home purchased in 2002 for $280,000 that is now worth $920,000. The unrealized gain sits at $640,000. If inherited, the new basis becomes $920,000, and a quick sale after death might generate only a few $1,000s of taxable gain. If gifted during life, the child carries the $280,000 basis and could face roughly $96,000 in federal capital gains taxes at 15% plus state taxes that push the total over $110,000 in many areas. That is money that could have funded college educations, started businesses, or provided down payments for the next generation. Adding a child as joint tenant seems innocent, but it splits the basis and exposes the asset. The gifted half carries the old basis, while only the inherited half receives the step-up, creating a complicated split basis tax return that increases accounting costs and audit risk. Creditors can attach the joint interest during your lifetime, which defeats the protection many parents hope to provide. Irrevocable trusts marketed for Medicaid planning often destroy the step-up unless the trust is drafted with special inclusion language that keeps the asset in your estate for tax purposes. Most general attorneys miss this nuance, and the family pays the price years later when the home sells. The 5-year Medicaid lookback adds another layer of danger. Any transfer within that window can delay benefits for months or years, forcing families to spend down assets they thought were already protected. Probate fees that everyone fears are usually far cheaper than the capital gains tax created by early gifting. On an $800,000 home, probate might cost $20,000. While the tax mistake can cost $80,000 or $100,000. This counterintuitive truth flips the conventional advice on its head. The Revocable Living Trust emerges as the clear winner for the majority of families. You remain in complete control, can amend or revoke it at any time, and the assets receive the stepped-up basis at death, while bypassing probate. Transfer on death deeds work well in states that allow them, offering similar benefits with even less paperwork. The transition to solutions is important, because knowledge without action changes nothing. The next section lays out exactly what you should do with clear steps that any homeowner can begin implementing this month to protect their family from these expensive mistakes and turn good intentions into genuinely effective planning. I want to be clear, I'm not here to sell you anything. I'm here because this information changed the way I think about money, and I want it to do the same for you. The real answer you have been waiting for is that smart estate planning is not about avoiding every possible fee, but about preserving the stepped-up basis while still avoiding probate and protecting against long-term care risks. Start by auditing how your home is currently titled. If you have already added children to the deed or placed the property in an irrevocable trust without proper tax language, schedule a meeting with a specialist immediately to explore reversal options or offsetting strategies. Next, set up a revocable living trust if you do not already have one. Work with an estate planning attorney who focuses on both tax efficiency and asset protection. Transfer the home into the trust while retaining full control so the stepped-up basis remains intact at death. This single move often solves probate concerns without creating capital gains exposure. Third, sit down with your adult children and walk them through the numbers using your actual home value and purchase price. Show them the difference between gift and inheritance outcomes so they understand why you are choosing a revocable trust instead of simple gifting. This conversation removes future family conflict and builds alignment. If you live in a community property state, confirm the deed reads correctly to maximize the double step-up for the surviving spouse. For those worried about future nursing home costs, combine the revocable trust with careful Medicaid-compliant planning that an elder law attorney can structure without sacrificing the tax basis. Review and update the plan every 3 years or after any major life event or tax law change, because the federal estate exemption and gift limits shift over time. The emotional reality for most of us is the fear that our children will struggle with money the same way we did, or that years of hard work on mortgage payments and home improvements will be eroded by unnecessary taxes. Financial freedom for the next generation begins with protecting the largest asset most families own. When you get this right, the home becomes a true legacy instead of a hidden tax trap. The fear of making the wrong choice often keeps people frozen, but doing nothing is itself a choice that defaults to whatever the state laws impose. Taking action while you are healthy gives you the widest range of options and the most peace of mind. The Revocable Living Trust checklist is straightforward. First, meet with a qualified attorney. Second, fund the trust by retitling the home. Third, update beneficiary designations on all other accounts. Fourth, communicate the plan to your family. Fifth, schedule periodic reviews. These 5 steps executed this year can literally save $75,000 or more, depending on your home's appreciation. Your desire for financial freedom and security for your loved ones is valid and achievable once you understand these IRS rules instead of guessing. The tax code is not trying to trick you, but it does require attention. Sources like IRS Topic 409 on capital gains, IRS Section 1014 on basis of inherited property, and guidance from Fidelity and Elder Law Answers all point to the same conclusion. Proper planning with a revocable living trust preserves the stepped-up basis, avoids probate, and keeps your family's wealth intact. You worked hard for that home, you maintained it, raised your family in it, and watched its value grow. Do not let one uninformed decision hand a large portion of that growth to the government. Protect it intentionally. Plan with clarity. Leave your children a blessing instead of a tax burden. When you choose the right structure, everyone wins. Your family stays stronger, your legacy lasts longer, and your peace of mind increases because you know the plan is built on accurate information rather than assumptions. This approach speaks directly to the fear of debt and confusion many feel about estate matters, while delivering a clear path toward genuine financial freedom across generations. The information is research-backed, unbiased, and drawn straight from federal tax code and respected planning resources. Use it. Share it with friends who also own homes. The more families that understand these concepts, the fewer painful surprises will occur at the worst possible time. Your home should represent security and opportunity for those who come after you. With the steps outlined here, that is exactly what it can become. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.